delay. Right. Okay. So we'll start. So now in your business finance syllabus, we have completed most of the things, right? Introduction to finance, then financial markets, cost of capital, valuation, and you have been given a group activity as well to submit with regard to the time value of money, right? And we did a big question in last week, exam type question for the cost of capital. And I have uploaded your group assignment as well, right? I have uploaded your group assignment as well. So if you have any doubt, right, definitely you may have doubts. If you have any doubts and please don't hesitate to come and ask, right? Any doubt will be fully clarified. Okay. So now today we are going to start this lesson, capital structure, right? Very simple lesson, right? At least a bit difficult. Right? It's capital structure. Right. Okay. So now I strongly believe that you have a very good understanding about our previous lessons, basically cost of capital, right? I thoroughly believe that you have a very good understanding about this cost of capital lesson because you need to have that knowledge to get the proper or a clear idea about this particular lesson, capital structure. Right. Okay. So let us look at the things that we are going to discuss here. Right. So after you complete this particular lesson, you should be able to differentiate operating leverage from financial leverage. Then you should be able to examine the impact or the effect of leverage on profitability, as well as outline different theories that explain the relationship between firm value and capital structure. So these are the knowledge levels that you are going to get once we complete this particular lesson. Okay, so then this is our roadmap. First, we are going to discuss about operating leverage and financial leverage, then the impact of leverage on profitability, and finally the capital structure theories, right? Okay, so before we are going to learn about these operating leverage, financial leverage, and these theories, you need to know what is the meaning of this capital structure. What do you think? What is capital structure of a company? Yeah. Online students, I think you can hear me, right? The presentation is also visible. Is everything fine, right?
Yes, sir.
Okay, right. Yes, what do you mean by capital structure? Any idea? Capital structure. Capital structure is what? Yes, good. Simply, in a very simple way, the way in which the company has funded, it could be either whole equity or equity and liability. So simply, that is the meaning of capital structure, how the company is being funded, right? How the company is being funded. Now, if you look at, right, so this is a simple capital structure example for a simple capital structure, right? So you have equity, right? Then you have debt component, equity and the debt component. So equity could be 60%, example, and the debt would be 40%. So simply it's equals to 100, right? It's equals to 100. Right. So here you could see it simply says the term capital structure is used to represent the proportionate relationship between debt and capital. So it simply tells you how much of debt that you have in your company and how much of equity that you have in your company. Simply how you fund to this company, right? The way in which that you have obtained sources, funds to finance your investment activities, right? So that is simply the capital structure. Basically, you have debt and equity. So here it says the various means of financing represents the financial structure of an enterprise. Yes, various sources. Have debt capital, you could have equity capital. If you look at this debt capital, you may have differentials, you may have bonds, right? Likewise. Right, and if you look at the balance sheet here, the left-hand side of the balance sheet tells you the equity part, and the right-hand shows you the asset part, right? So simply you have the funding methods in your left-hand side or the upper of your statement of financial position, and then the bottom or right-hand side of your statement of financial position, you have your assets. Simply, right? You look at the balance sheet. So here you have your, this is the previous version of the balance sheet, but it's very clear, right? So you have your equity part here, right? Then you have your debt part here, right? Debt part here, long-term borrowings, and here you have your assets, right? Assets, non-current assets, likewise, right? So simply, these are the funding sources, and this is how you obtain the funds, and this is what you have done for these funds, right? So the assets shows that, right? For two investments in your long-term assets, you have obtained funds in terms of equity as well as in terms of debt. Then it says the traditionally short-term borrowings are excluded from the list of methods of financing the company's capital structure. Now, here we mainly focused on long-term investments, right? So here you might wonder that I haven't mentioned current assets there, right? Why? We are not considering about the current assets when it comes to this capital structure discussion, right? So current assets are coming under working capital management, right? Current assets are coming under working capital management. Accordingly, we are not going to consider that part here. This is purely based on how you fund your long-term investments, right? You have your long-term investments, and here we particularly looking at how you fund your long-term investments, either by issuing equity or debt or both. Clear? So that's the simple idea of the capital structure, the way in which the company has fund their long-term investments, either could be debt or equity or both. Right. Now, if you look at this particular illustration here, right? So here, you know, capital budgeting, right? It's purely based on your long-term investments, right? Capital budgeting means it's purely based on your long-term investments. So it could be either the replacement or modernization or expansion or even a diversification, right? You are trying to expand, you are trying to replace one factory with another, right? You are trying to open a new building or a new factory, new premises in Sri Lanka or another country, right? Expansion, again, you are trying to expand your business, and even diversification. You could be in one industry today, but you are planning to go to another industry. Right now, you are in the hospital sector, but you are planning to expand to hotel sector, right? Capital goods sector, something like that. So that is the meaning of diversification. So that is the decision that you are going to take, right? In a company, this is the decision that you are going to take. So this is what investments, right? All these are your investments, long-term investments, decisions. Now, when you are going to make that decision, you need to always think about what? How we are going to get funds for that investment. That is simply your financing decision, right? So capital structure is entirely the decision regarding the financing decision, right? So when it's come to this need to raise funds, you have three options, right? You can check whether you have reserves with you, right? Then you can check whether the debt capital is available, and finally you can go with external liquidity. Up to now, okay, right? First, you have your long-term investment decisions. Then you need to decide how you are going to fund for that, right? That is simply your financing decision or capital structure decision. You can either look at your reserves, debt, then equity to get the finance, right? So that is what we known as capital structure decision, right? That is what we known as capital structure decision or finance decision. Both are same, right? Both are same. Now, when you are going to make that capital structure decision, you need to think about your existing capital structure. And also, you need to think about your payout policy. You need to think about your payout policy. For an example, let's assume that now this is your existing capital structure, right? This is your existing capital structure. You have 60% of equity and 40% of debt capital. Clear? This is your existing capital structure. Now you are going to make those investment decisions, right? You are going to make those investment decisions according to this particular illustration. Then you need to decide how we are going to fund for this investment, right? Again, your capital structure decision. So definitely this could change, right? This could change, right? So here, let's say, yeah, now you need to decide how much of equity that you are going to have and how much of debt capital that you are going to have. Clear? For an example, let's say you have decided to go with, right, 70% of equity and 30% of debt capital, right? 70% of equity and 30% of debt capital. That is the decision that you are going to take. Okay. But before you are going to make that decision, you need to think about your existing capital structure, right? This is your existing capital structure, right? Earlier, the equity portion was 60%, but now we are trying to increase it by 10%, right? So accordingly, it is 70%. Earlier, your debt portion is 40%, but now we are trying to reduce it by 30%. Simple example, right? And also you need to think about your payout policy. Payout policy means what? How much you are going to distribute out of your earnings to your equity shareholders, right? How much you are going to distribute out of your earnings to your equity shareholders. Now, if the equity portion of the company is high, what do you mean by that? You need to have a higher payout policy or a lower payout policy. I'm asking the amount of dividends that you are going to pay. Will it be lower or higher compared to this? It's higher because you increase your equity capital by 10%. So definitely payout policy could be same. It is a percentage wise, right? But the amount of dividend that you have to pay could be high. Simultaneously, you have to think it, right? If you increase your equity portion, fine, you can get the financing, but at the end of the year end, you have to pay the dividends for those. You are thinking about your existing capital structure as well as what? Your payout policy. Clear? Based on those two decisions, you have to decide the desired debt to equity mix of your company, right? Desired debt to equity mix of their company. So it could be either lower than this or could be higher than this. Clear? That is the thinking part that you need to have. Now, when you are going to make that particular decision, right? So this is the amount of debt that we are going to have in our company, and this is the amount of equity that we are going to have in our company. So definitely it's a decision, right? So decisions are having what? Risk and a corresponding return. So once you are going to make that decision, definitely it may have a risk as well as a return, right? Then what happens? Both this return and risk may impact on what? Companies cost of capital. Can you remember this? So cost of capital depends on the riskiness of the cash flows, right? Riskiness of the cash flows. So accordingly, this particular decision is having an impact to the company's cost of capital, right? Company's cost of capital. Up to now, is it clear? Right? Because as an investor, if you observe that the risk of your investment is high, you're asking a more return from the company. So accordingly, the company has to pay it. So it is a return for you, but on the other way around, it's a cost for the company. So since the risk is high, the return is also high, and the company's cost of capital will also be high. Clear? Company's cost of capital also be high. Then what happens? This cost of capital is having an impact to the value of the firm. Value. You have done valuation, right? Right. You have done valuation. So we know that how to calculate the value. It's simply we are discounting the present value. We are discounting the future values that we are going to expect from a particular investment. Right. So that is how we get the value of a company. Right. For an example, I can write here. Right. Value equals to present value of future cash flows. This is how you calculate it. Right. And for you to calculate this value, right? So simply there are a lot of models for calculate the valuation, calculate the value. So let's say you assume that you are going to have a particular net operating income in perpetuity, right? In perpetuity. and you need to discount it by cost of capital to get the answer. Correct? This is your future cash flow. Let's assume that you are going to, as a company, right? As a company, you are going to get a particular net operating income, and you assume that that operating income will therefore go till perpetuity. So that is your future cash flow. Clear? So that future cash flow you need to discount from the company's cost of capital. So that is how you calculate the value of a company, right? Earlier we calculate the value of a share, value of the bond, but as a company, based on the income method or net operating income method, this is how we calculate the value, right? So simply, this valuation could be impacted by the company's cost of capital, correct? Based on the equation, can you see it? This valuation could be impacted by the company's cost of capital. So if the company's cost of capital is high, the value would be low. If the company's cost of capital will be lower, value would be high. Okay. So simply, your capital structure decision is having an impact to the company's cost of capital, right? Cost of capital. Because if you increase the amount of debt capital in your company, it is a risk for your equity shareholders, right? It is a risk. Why? Since you have increased the amount of debt capital in your company, it implies that you are going to give the priority for your debt holders at the time of liquidation. So accordingly, it is a risk for the equity shareholders. Why? They have not been guaranteed that they will be given the priority at the time of liquidation, and they have not been guaranteed that they will get the dividends as well. Okay, so it is a risk for the equity shareholders. So accordingly, what will happen? They are trying to ask a more return from you. Then your cost of capital will be high. So I strongly believe that you could remember these things because we have done this for the introduction of business finance under the capital structure part, and also the cost of capital as well. Right. So the cost of capital will be high. So cost of capital will be high means the company value will be lower, and if the cost of capital is low means company value will be high. Clear? So that is how the cost of capital impact to the value of the firm. Then what you have to do, since as a finance manager you know these things, you need to come up with optimum capital structure, right? Optimum, right? Optimum. You need to come up with optimum capital structure, which means once you have this optimum capital structure, your cost of capital will be lower and the value of the company will be high. That is the meaning of optimum, right? Optimum capital structure. You're having this much of a debt capital, you're having this much of equity capital. Accordingly, cost of capital would be lower. At that time, value of the company will be high. So as a finance managers, we are trying to maximize the shareholders' wealth. Simultaneously, we are looking at to maximize the value of the company. So this is the ultimate target of the capital structure decision. Okay. So please look into these two slides. Check whether you're okay with these things. If you have any doubt, you can ask online students. You also. You need to have a very good understanding about the cost of capital lesson, the previous lesson, to understand this clearly. Like if you have any doubt, you can ask one. Only technical lah. Yes, on the incidents, anything that you need to clarify? Any matter that you need to clarify? Yes, any matter? Okay,
Yes, it's fine.
so please think in a practical way, right? So it's like a story, right? It's like a story, right? You are going to make your investment decision now. This I'm summarizing now. I'm summarizing this part, right? Again, you can look into this yellow color one. You are going to make your investment decision, right? To make your investment decision, you need what? Funds. You can issue equity capital, or you can issue debt capital, or you can issue both. Clear? But when you are going to make that decision, you need to think about what about your existing capital structure, right? How much of equity capital that we have up to now? How much of debt capital up to we do we have up to now, right? Then also you need to think about your payout policy, right? The amount of dividend that you are going to pay for your shareholders, because you are going to make a decision, right? To make a decision, you need to have a very good sound background. So based on that decision, right? Based on that background, you make that decision about your capital structure. Okay, so this is the amount of equity that we are going to have, and this is the amount of debt that we are going to have. Clear? So when you are going to make that decision, or when you are making that decision, definitely it may have a risk as well as a corresponding return, right? So if you increase your debt capital more, it may have a risk to your equity shareholders, right? So then they are asking a more return, you have to pay it. Clear? So your capital structure decision, therefore, is having an impact to what? Company's cost of capital. Company's cost of capital. And you know that when we are doing the valuation, we discounting all other future cash flows from the company's cost of capital, right? From the company's cost of capital. So here we took the net operating income of a company, right? Simply the future cash flows of a company. And we simply assume that for this illustration, right? We assume that the company may get this particular net operating income till perpetuity. So we discount it from the company's cost of capital. So that is how we calculate the value. Now you can see that this cost of capital is having an impact to the value of the firm. First, mathematically, if this is constant, if you increase your cost of capital, the value will be lower. Keeping this constant, if you decrease the cost of capital, your value will be high, right? Your value will be high. So since your capital structure is having a significant impact to the cost of capital, thereby to the ultimate value of the company, you need to make the optimum decision. You need to have optimum capital structure. Optimum, prashasta, right? Optimum capital structure. So that capital structure will provide you the lower cost of capital and maximum value to the company in a very simple way. It's a story, right? It's a story, right? Right? Clear? So far, so good. Okay. Okay. Fine. Right. So now let us move to financial leverage. Actually, you know these things, isn't it? Financial leverage. Right now, we are going to discuss about this leverage part. Now you have a sound understanding about capital structure. Now let's look into this leverage. Now, when it comes to the leverage, we are having both financial leverage as well as operating leverage. Now, what do you mean by financial leverage? Financial leverage? Yes. Financial leverage is what? The amount of debt capital in your company compared with equity capital or the total capital of the company. The percentage of your debt capital out of the total capital structure value of the company. That is what we known as financial leverage, right? Financial leverage. So here, yeah, financial leverage, right? the amount of debt capital in your company as a percentage of equity capital, right? You're having this much of a debt capital, you're having this much of a equity capital. Let's say your debt capital is 100,000 and your equity capital is 200,000. So what is the financial leverage? How much? 50%. Clear? It's 50%. So simply the percentage debt capital in your company to the equity capital. Or you can consider it like this: the amount of debt capital in your company to the total capital structure. Right? The amount of debt capital in your company to the total capital structure. So here your debt capital is 100,000 and the total value of the company or the total value of the capital structure is 300,000. So what would be the answer? It's nearly 33.3%, right? Either way you can take it as a percentage of equity capital or as a percentage of total capital structure of the company. That is simply what financial leverage is. So here it says the use of fixed charges, sources of funds. Fixed charges means debt capital, right? It's fixed, right? Debt capital is fixed. Either if you look at the bonds, the interest rate is fixed. And if you look at the preference shares, the preference dividend is fixed. Right? The use of fixed charges, sources of funds such as debt and preference capital, along with the equity in the capital structure could be considered as financial leverage or gearing or trading on equity. Right? Financial leverage, gearing or trading on equity. Okay. So these are another synonyms that you could use. Then the financial leverage employed by a company is intended to earn more return on the fixed charges of funds than their cost. Right now, simply for an example, let's say, right now here we are looking at the final para. So here it says, if you borrow money, right? If you borrow money at a rate of, let's say, 5%, right? You borrow money at a rate of 5%. So this is your interest. This interest you have to pay. Okay. So your return must be higher than this or lower than this. The company return must be higher than this or lower than this. The company return must be higher than this. Simply it could be 7% return on equity or return on asset, whatever. Right? So otherwise, how we are going to pay this? Right? So for an example, let's say you borrow money from a bank to buy a car, and you have to periodically monthly pay the interest amount. So which means you must want to earn more than that. Right? So simply when it comes to the company as well, when they are going to borrow funds, they always believe that they are getting a higher return more than the cost of borrowings. Right? More than the cost of borrowing. That is what here it says. The financial leverage employed by a company is intended, they are planning, right, to earn more return on the fixed charge funds than their cost. Right? They are borrowing to generate returns. So they are trying to get more returns than the cost of borrowings. Right? So then you could see these are the three measures that we could use to calculate the financial leverage. Right? Three measures, very simple. Right? So this is the first one that we have done. The second one, we call it as debt ratio. You provide the percentage of your debt capital out of the total capital value, total capital structure value of the company. So we call it as debt ratio. And here we call this as debt to equity ratio, right? Why? Here you only consider about debt component with equity component, debt to equity. And the other one is interest coverage, right? So here it says earnings before interest and tax, depreciation and amortization divided by interest. So interest coverage ratio. How many times you can cover your interest? So that is another method that we are using to calculate the financial leverage. So here it says the third measure of the financial leverage is commonly known as coverage ratio, right? So you might know these ratios, coverage ratios. So the reciprocal of the interest coverage ratio is the measure of firm's income gearing. You can, right, put it upside down, and if you do it, we call it as income gearing, right? Now, EBIT, TA divided by interest is your coverage ratio. If you divide your interest from the earnings before interest and tax, depreciation and amortization. So this is the reciprocal of that, right? Opposite version of that, we call this as income gearing, right? Income gearing. Right? Income gearing. Right? So it's all about financial leverage, right? Financial leverage. What financial leverage says simply the amount of debt capital in your capital structure as a percentage of equity capital. Or the amount of debt capital in your capital structure as a percentage of total capital structure value. So could you please read these two slides? Please read these two slides. If you have any questions, any clarification. So are you studying for the exam? Will you have your exam? In the next month. What is your start studying now? Especially start studying now. If you have any clarification, you can ask. Right, okay. Yes, online students, are you all okay with this up to now? Yes, are you all okay with this up to now?
Yes, sir.
Right, okay. Shall I erase this? Shall I erase this? Shall I erase this? Okay. Right. Okay, right. So now we are going to look at something called degree of financial leverage. Right? We are going to look at something called degree of financial leverage. Right? Right? Degree. Listen now. Degree of financial leverage. Okay. So now, how you calculate this degree of financial leverage? Right? How you calculate this degree of financial leverage? It's simply, right, degree of financial leverage equals to percentage change, right? Percentage change in your earnings before interest and tax over percentage change in your EPS. Percentage change in your EPS. So simply, Buddha, this measures the sensitivity of your earnings per share to the earnings before interest and tax. Okay, so this simply measures the sensitivity, right? The sensitivity of the earnings per share for the earnings before interest and tax, right? For the earnings before interest and tax, or even you can consider the change in, right? It has been more. Yeah. Okay, fine. Right. So this is what you known as the degree of financial leverage, right? Degree of financial leverage. Okay. Sensitivity of your earnings per share to the changes in earnings per share, right? The changes of your earnings per share. Right. Okay. For an example, let's say, right, in year 2022, this is your earnings per share. This is the earnings before interest and tax. In 2023, you may have another value. Let's say here it's 5 and here it's 7. Earnings before interest and tax is 100. Here it's 120. Right? Here it's 120. 120. So can you calculate the degree of financial leverage? Please calculate the degree of financial leverage. Right? Your degree of financial leverage equals to the percentage change in your EPS. 7 minus 5 divided by 5 multiplied by 100. 120 minus 100 divided by 100 percentage. Degree of financial leverage equals to how much? Degree of financial leverage equals to yes, online plus. What is the answer? Yes. Yes, online students, what is the answer? How much? How much? Exactly 2. Yeah, it's 2%. Okay, fine. So this means every 1% change in your earnings per share, sorry, earnings before interest and tax, there's the corresponding change of 2% in EPS. This is the meaning of this degree of financial leverage. Every 1% change in your earnings before interest and tax, your EPS changes by 2% because it measures the sensitivity, right? It measures the sensitivity of the earnings per share to earnings before interest and tax. Earnings before interest and tax. Right? Earnings before interest and tax. Any 1% change in your earnings before interest and tax, it may have a corresponding change of 2% in your earnings per share, right? In your earnings per share. Okay, financial leverage, easy, right? Easy things, right? Financial leverage. Okay. Then we are moving to something called the impact of leverage on profitability. Actually, you have learned these things, right? Impact of leverage on profitability. You have learned these things because at the very beginning we discussed the same thing, right? We discussed the same thing. Excuse. Right. Okay. Effects of leverage on profitability. Okay. Right. Now, simply you said that. Right now, here it says the earnings per share, return on equity and return on equity are important figures and analyzing the impact of financial leverage. Now, first two equations, you know those things. That is how we calculate the earnings per share as well as the return on equity, right? Earnings per share as well as the return on equity. So now what is our objective here is our objective is to identify the impact of financial leverage on the company profitability, right? The impact of financial leverage on company's profitability. Now, if you look at the research done in this finance sector, there could be different impact on leverage to the profitability, right? The leverage to the profitability. But we believe that if you are in a position to generate a higher return than your cost of borrowing, right? If you are in a position to generate a higher ROI, return on investment, than your cost of borrowing, it may have a profitable impact, it may have a favorable impact to the company's profitability. And if you are in a position to generate lower return on investment than your cost of borrowing, it's not favorable, it's unfavorable. So since we have higher and lower, it is sufficient to assume that equal part as well, right? If you are generating a return which is equal to your cost of borrowing, we call it as is a neutral situation, right? Neutral situation. So this is the impact of leverage on companies' profitability. Simply think about your home, right? You're borrowing something to buy, right? Let's say you borrow certain amount at an interest rate of 5% and you are going to buy a car, right? So definitely you need to generate a sufficient income more than your cost of borrowing. Is that clear? So same thing applies to here as well. So you need to generate a higher return more than your cost of borrowing. If it happens, definitely it may have a favorable impact to your profitability, or otherwise it's unfavorable, right? It's unfavorable. It's something like, you borrowed something and you need to earn a higher employment income to pay that. Otherwise you can't. Same thing applies to company as well. Company borrow money either by issuing debt, preferred shares or bonds, and they have to periodically facilitate that. So definitely the company must want to earn a higher return to pay that amount. Okay, that is the idea behind this, right? Effect of leverage on return on investments and EPS. And so definitely you need to earn a more return than the cost of borrowings. Otherwise, you are not in a position to pay the interest amount for whatever the guaranteed liability amount. Right? Okay, so please take a look at the things that we have done up to now. Please take a look at the things that we have done up to now. We started with discussing capital structure, where you understood what is the meaning of capital structure, right? Then we discussed about what is financial leverage and what is operating financial leverage, right? Then the degree of financial leverage, then the impact of financial leverage into profitability. There could be different impacts according to the research findings. Theoretically, we believe that this is the way. I just think whether you are okay with these things. Huh? Yes, sir. Online students, are you clear with this? Online students, are you okay with these things?
Yes, sir, it's okay.
Yes, sir.
Right. Okay, fine. So now we are moving to something called operating leverage, right? Operating leverage. Now, in a very simple way, operating leverage is the amount of fixed cost in your company compared with the total cost. In a very simple way, right? The amount of the company's fixed cost compared with its total cost, right? Its total cost. So here it says operating leverage, right? You could see operating leverage affects the firm's operating profit, right? If you're having a higher operating leverage, meaning that you have higher fixed assets. So which means you need to generate sufficient sales to recover that fixed cost, right? And low operating leverage means you are having a low fixed cost, which means you can recover your fixed cost up to some extent. You don't want to do much of an effort to make the sales, right? Simply, that is how the operating leverage impact to the company's profit, right? The company's profit. So operating leverage is what? It's simply the percentage of company's fixed cost to its total cost, right? So this fixed cost or this particular operating leverage is having an impact to the company, what? Operating profit. Because if you're having the high fixed cost, it is fair to believe that your operating profit will be low, right? And if you are having a low operating leverage, yes, again, it is fair to believe that your operating profits will be high, right? Low operating leverage, fixed cost is low, right? On the other hand, you need to maintain a variable cost element, right? Okay, so that is operating leverage. Now again, we have something called degree of operating leverage. Now you got to know what is degree of financial leverage. On the other hand, we have something called a degree of operating leverage, right? Degree of operating leverage, right? Degree of operating leverage. So it is simply the changes in the company's sales as a percentage of, right? Right, sorry, earnings before interest and tax as a percentage of changes in sales, as a percentage of changes in sales. Right, so here it simply measures the sensitivity of the company's earnings before interest and tax to company sales. Sensitivity, right? Sensitivity of the company's earnings before interest and tax to company sales. Company sales. Right. So let's say here your earnings before interest and tax. Right. Earnings before interest and tax. Let's assume here it's 50 and here it's 70. Right. Your sales are 100 as well as 120. Right. 120. Accordingly, let us calculate the degree of operating leverage. Right. Degree of operating leverage equals to percentage change in your earnings before interest and tax. Right. 70 minus 50 divided by 50 multiplied by 100. The percentage change in your sales is 120 minus 100 divided by 100 into 100. Degree of operating leverage. How much is it? Yeah. It's 2. It's 2%, right? Degree of operating leverage is 2%. Why? So here it says, right? For every 1%, this is the meaning of, for every 1% change in your sales, your earnings before interest and tax changes by 2%. Right? For every 1% change in your sales, your earnings before interest and tax changes by 2% because it measures the sensitivity. Right? Sensitivity of your earnings before interest and tax to the sales. Right? To the sales. So this is what we know as degree of financial leverage, right? Degree of financial leverage. Degree of financial leverage. The sensitivity of the earnings before interest and tax to sales. Your sales changes, definitely your earnings before interest and tax changes. So we want to know the sensitivity. Sensitivity. Right? Okay. Is this clear? Shall I erase it? Fine. Okay. Right. Now, right. So let's summarize. Let's summarize. Let's summarize. Listen carefully. Listen carefully and let's summarize. Okay. So you learn something called financial leverage. Clear? Financial leverage is what? The amount of debt capital in your company as a percentage of equity capital for the total value of the capital structure. Agreed? Good. So how you calculate the, after that you have done something called degree of financial leverage. Degree of financial leverage. So how you calculate this? Degree of financial leverage it measures the sensitivity, right? That is what you need to know. It measures the sensitivity, right? Sensitivity of the earnings per share of a company to its what? To its earnings before interest and tax. Earnings before interest and tax, right? Sensitivity of the earnings per share to the earnings before interest and tax. In there, you got the answer as 2%, which means for every 1% change in your earnings before interest and tax, your EPS changes by 2%. Okay, done, good. Right. Thereafter, you learn something called operating leverage. Operating leverage is the amount of fixed cost in your company as a percentage of total cost. Based on the high or low operating leverage, it may have an impact to the operating income. Operating income, thereafter operating profit, right? Then you learn something called degree of operating leverage, right? Degree of operating leverage. What does it measures? It measures the sensitivity, right, of the earnings before interest and tax of your company to its sales. Clear? To its sales. Clear? So India also we got the answer as 2% because we just shuffled the numbers, right? So it says for every 1% change in your sales, the earnings before interest and tax changes by 2%. Clear? Understood? Right. Right. So here you can easily set off these two. And finally, you have something called changes in your earnings per share divided by percentage change in sales. So we call this as combined, right? Combined leverage. Right? Combined leverage. If you want to calculate the combined impact of the both financial and the operating part, this is the way that you do it. Right? This is the way that you do it. So if you look at the formula there, it says, don't look at the below one now. Look at the previous one. That part. Combined leverage. So here it says operating leverage affects the firm's operating profit, while the financial leverage impact on earnings per share. Right? The degrees of operating leverage and the financial leverage, right, is combined together to see the total impact. To see the total impact. Ask me multiplication, huh? To see the total impact. So this is the total impact, right? We are having this much of a net capital, your company is having this much of a fixed cost. What is the combined impact to it? Okay, happy? Very happy? Right? Any doubts up to now? Any doubts? Just think, online students also please do the same thing. Just think whether you are okay with this up to now. Right? Just think, I'll give you 5 minutes. If you have any doubt, please ask. Please ask. If you have any doubt, please ask me first. Then you can discuss the matter with the friend. First you get know the things exactly correct. You want to verify for calculations. Don't need these formulas for examination, like simple formula. B. This things properly, you know these things, right? Whether you know these things, we have read out, you can ask. But because it's not coming there, then we are doing after we are not taking the learnings. The other side of the equation. Actually. Right. Okay, fine. Hola, okay. Do you need a summary? No, right? Fine, good. Right, so 2 minutes break. 2 minutes break. Please have a water. Please have it. Please have a. Right. Okay. Fine. So now we are going to look at the impact of capital structure theory to the firm value. Right. So now we are going to listen now. Now we are going to look at the impact, right? The impact of capital structure theories to the company value. Right. So if you look at the learning outcomes of our lesson, capital structure lesson, the first learning outcome is differentiate operating leverage from financial leverage. Do you know it? Okay. They examine the effect of leverage on profitability. Do you know it? The effects of leverage on profitability. Do you know it? Okay. That, right. So the final part is we need to look at the impact of capital structure theories on firm value. Right? Capital structure theories on firm value. Now, okay, so please listen now. So if you look at this particular illustration, we have done this earlier at the very beginning of today's lecture. We discussed this. So here you could see that the capital structure decision is having an impact to the company's cost of capital. Right? Listen this carefully. Yeah? The capital structure decision is having an impact to the cost of capital of the firm. Ultimately, that is having an impact to the value of the firm. Understood? Or can you remember it? Right? Capital structure decision is having an impact to the cost of capital. Yes, you know why, we explained. Then the cost of capital is having an impact to the value of the firm. Again, you know it, we discussed it. Accordingly, you need to determine the optimum capital structure for your company. Right? How much of debt and how much of equity that you need to have. Why? If you have the optimum capital structure, it reduces your cost of capital and simultaneously it will increase the value of the company. So we need to look at what type of theories are there which illustrate this relationship. Right? We need to look at what type of theories are there which illustrate the relationship between the capital structure and the firm value. For that, we have to learn about some of the capital structure theories, right? Some of the capital structure theories. That's the objective. What? The objective of learning capital structure theories, why? To identify the impact of different capital structure theories to the firm value, right? To the firm value to determine the optimum capital structure to the company. Determine the optimum capital structure to the company, right? Okay. So here it says the objective of a firm should be directed towards the maximizing the firm value. Now, if you look at the objective of finance, that is entirely focusing on shareholders. We need to maximize the shareholder value in terms of maximizing the current market price per share. But as a company, we are trying to maximize the value of the company. Right? So the capital structure or financial leverage decision should be examined from the point of its impact on value of the firm. That's why I told you, yes, we want to analyze which type of an impact does this capital structure is having on value of the company. Okay. So accordingly, we have 4 theories to be learned, very simple theories, right? The first one is net income approach. The second one is traditional approach. Third one is hypothesis with and without corporate tax. Means declining Miller, right? And the other one is pecking order theory, right? The other one is pecking order theory. So these are the theories that you are going to learn, and don't worry, you don't have calculations. Huh? If you want, we can discuss. Don't. Sometimes in the examination, right, okay. So now let's start with learning about this net income approach, right? Yeah, it's net income approach. Don't look at Jan. Don't look at me. Okay, it's net income approach, right? Net income approach. Right. Right. Net income approach. Net income approach. Right. So when it's come to this particular theory, now we are going to identify which type of an impact does this particular theory is having on company value. That's our objective, right? Okay. Now in this particular theory, we assume that no taxes are there, no transaction cost. Okay. Debt is risk free, right? No transaction, you could write it down now. No transaction cost, no taxes, debt is risk free, and the cost of equity does not change with financial leverage. Cost of equity does not change with financial leverage, right? But before learning about any capital structure theory, let us look at what will happen. Now, for an example, let's say if the debt amount of your company is high, right? Let's say debt capital of the company is high. Okay, then what will happen? Debt capital of the company is high, right? Debt capital of the company is high. Now you all assume that you all are the shareholders, right? Assume that you all are the shareholders in a particular company. If the debt amount of the company is high, right? Is it a risk to you or not? First, you need to think like that. Huh? When the debt level of the company is high, is it a risk or not? It's a risk, right? It's a risk. So we call it as financial risk, right? Financial risk. If the debt level of a company is high, the financial risk of the equity shareholders will be high. Agreed? Okay. Then what you do? Now you all are the shareholders, please tell me. What you do? You need to compensate for this risk. Clear? You need to compensate for this risk. Then what you ask? Yes, you are asking a higher required rate of return from the company. Right? You are asking a higher return because you are bearing a significant amount of risk. Then the company has to pay it. Accordingly, the company's cost of equity will be higher all over higher. So this is the principle that you want to know, right? When the debt level of a company is high, the financial risk is high. Why? You are not sure that you are going to get the dividends, and also you are not sure that you know that you are not getting the priority at the time of liquidation, right? So it's a risk for you. So we call it as financial risk. The financial risk is high. So since the risk is high, you need to compensate for that risk. Accordingly, you are asking a higher required rate of return from the company. So the company has to pay it, and we call it as cost of equity, and that cost of equity is high. Clear? That is the principle that you want to know. According to this model, we assume that no taxes are there, right? No transaction cost. Debt is risk-free, right? Like that. And the cost of equity does not depend on financial risk, which means whatever the financial risk is there, whatever the financial leverage is there, right? You don't bother about it. You don't bother about it. So accordingly, what happened? Your cost of equity remain same, right? Your cost of equity remains same. So this is the debt to equity mix of a company, and this side is the cost. This side is the cost. So whatever the financial leverage that is there in the company, as equity shareholders, you don't bother, right? You don't bother. This is the theory. Yeah? Practically, it could be different. Yes, this is the theory. Okay. So then what happened? You know that you have cost of debt, right? And it is constant. Cost of debt, it is constant because you have been guaranteed that you are going to get a particular interest or a particular dividend amount. Up to now, okay, cost of equity is fixed, right? Without considering without considering the level of financial leverage, as well as the cost of debt, it's always constant, right? It's always constant. Why? You know your return, right? It's fixed. Accordingly, the line is a horizontal one, right? Line is a horizontal one. Okay, so now what happens, right? What happens? So let's assume that usually start from here. If you do not have any cost of debt component, right? If you do not have any cost of debt component, your cost of capital equals to what? You don't have any debt in your capital structure, only equity. According to your cost of capital equals to what? Very good. Your cost of capital is equals to equity, which means here. Okay, right. Then what happens? Now you are going to issue debt, right? You are going to issue debt and it is fixed. So when you are issuing debt, and here we believe that the cost of debt is cheaper, you can borrow debt at a lower cost, right? You can borrow debt at a lower cost. So when you are increasing the amount of debt capital in your company, little by little, your weighted average or the total or the cost of capital starts to decline because lower cost of debt, right? So when you are increasing more and more debt to the company, your cost of capital will be lower and lower, right? Your cost of capital will be lower and lower. Is that clear? Right? When you are issuing more debt capital to the company, since the cost of debt is lower than cost of equity, your overall cost of capital of the company declines. Okay, fine. Then by looking at this particular theory, what do you think? What is the optimum capital structure? You know, optimum capital structure means, right? Optimum capital structure means your overall cost of capital must be lower and simultaneously value of the company must be high. Value of the company must be high, right? So accordingly, what do you think? By looking at this figure, what would be the optimum capital structure which minimizes the cost of capital and maximize the value of the company? By looking at this graph, huh? Don't look at that slide or whatever. By looking at that particular illustration, please stay. At which point, now tell me at which point the company's cost of capital will be lower? At which point? Yes? Huh? This point. This. Then this point. Yeah. This point. Okay, so this at this point, company's cost of capital is lower, right? Which means at that time, according to that, value of the company should be high. Which means, right? You could see that when you are increasing the amount of debt capital in your company, cost of capital will be low. Clear? When you are increasing the amount of debt capital in your company, cost of capital will be low. Understood? Accordingly, what is best? Issuing debt or issuing equity? Issuing debt. According to this theory, based on assumptions, right? According to this theory, if you have your entire capital structure from debt, right? From debt, what will happen? The value of the company will be higher, cost of capital of the company will be lower, value of the company will be higher. Clear? Right? So this is the illustration. Right? So here you have your debt to equity financial leverage. Here you have the value of the company. Right? You are starting from here. This is the value of the company. This is the value of the company. This is the assumption, now. Again, I am saying cost of equity does not depend on the level of financial leverage, right? So accordingly, whatever the amount of debt capital in the company, shareholder don't bother. They ask a fixed return. Cost of debt, yes, you know, it's anyway fixed, right? It's anyway fixed. Accordingly, it's horizontally goes. At the very beginning, if you are equity finance company, you don't have debt, then your cost of equity equals to your WACC or cost of capital, right? WACC or cost of capital. So accordingly, both are same. When you are increasing little by little your debt components, we know that cost of debt is low compared to equity cost. Accordingly, your overall cost of capital will be lower and lower. Clear? Understood? So at this time, you said that the company's overall cost of capital is lower, which means at this time, value of the company should be high. Clear? So then, if you look at this particular illustration, if you issue more and more debt, your cost of capital will be low, right? The maximum amount of debt that you could issue is 100%, isn't it? So if you issue 100% debt capital, which means if you have your entire capital structure from your debt component, definitely the value of the company will be high, according to this theory. Yeah? Okay. If you are okay, don't read that. But if you are confident enough, better to read it as well. Yes, online students, are you okay with this? Online students, are you clear with this?
Yes, sir.
So what are the assumptions you have told?
Yeah, so you don't have any taxes, you don't have any transaction cost, and this cost of equity does not depend on the financial leverage. So otherwise it must be higher, right? I will explain it in our next part. Right? Okay. So sometimes in the examination, like we ask, differentiate one theory from another theory. Okay, differentiate one particular theory from another theory. Now we have this completed this in term approach. Then after we have the term approach and then people pass. We have to test. We might. No taxes, no transaction cost. And it's what if you just depend on one and it is what it depends. This part, because it. Yeah. You feel the size. Right, so if you are okay, we can. Look at next year example. You can have your break, huh? You can have your break. You can have 10:30. Yes, next we are going to have a break. So let's meet at 10:30. Let's meet at 10:30. Right.
Hello. Excuse me, sir.
Yes, yes, sir.
Sir, explain about little bit about this assignment, like the
Yeah,
topic that assigned to us, like
did you,
yeah.
Diane, are you speaking? You won't speak with me?
Yes, sir.
Yeah, this is that.
Sir, just to get some understanding about the assignment, that topic
Yeah,
that
sure.
the topic that assignment to us, like team number 5.
Uh-huh.
Uh, so from where, like from where we can gather the information for this? Is there any sources that we can gather this information for this, and what is the best method that we could follow for this? Because of I think the method that explained uh, in the assignment, I think it's not like we could. We can that means we cannot follow the same method because bit different from the guideline mentioned in the assignments.
It's your assignment. Yeah, it's a topic.
It's topic number 5, sir.
Yeah, what is the topic?
The effect of foreign international investment on stock market development evidence from Sri Lanka.
Yeah. So now, in a very simple way, we know that lot of foreign institutional investments are coming here, right? Usually, right? It could be low, it could be high, but currently, I'm not talking about present past, right?
Mhm.
So then you need to look at whether does that foreign direct investment is having an impact on the stock market development.
Mhm.
Okay, good. That is the topic. The clear idea about the topic, right? Now, when it comes to this foreign direct investments, basically you can take those things from central bank annual report as well as this investing.com.
Mhm.
Investing.com.
I'm not. I will check, sir.
Yeah, in that particular website, Puta, you can get an idea about, they provide all the details, country-wise economic data as well as financial data. So in
Mhm.
there, you can get the foreign direct investment data for certain years.
Okay.
Okay, good. Right. Then that is how you need to collect the data for the foreign direct investment. Let's say for the 2023 this month, 2021 this month. Likewise, in an Excel sheet, you need to insert those things. Okay,
Mhm. Mhm.
right, good. So then the other part is the stock market development.
Mhm.
Am I correct?
Yeah. Yeah.
Yeah. So stock market development, and actually I told you all to read certain articles simply to do a literature, right?
Yes.
Okay, so if you just copy paste the same topic in the Google, you may find certain articles with regard to
Mhm.
that.
Okay.
Okay, so they have mentioned how you need calculate how you need to calculate the stock market development. It could be either from the market capitalization. Let's say in 2020, the market capitalization is this much, but in 2022, the market capitalization is that much, which means there's a development in the companies, so the market ultimately, right? So
Due
stock
to this
market,
foreign, due to this
yeah, yeah.
influence of these investments.
Yes, yes, stock market development to be captured using this market capitalization yearly. Total market capitalization of all the companies could be used as a proxy. I'm just saying there are some very good variables other than this for you to make a clarity, right?
Mhm.
Okay, so once you have those two data, you can run a regression in a Excel. Right? So you can just type how to run a regression and interpret the results in Excel in YouTube. So they will
Mhm.
provide all the details on how to run this particular regressions, how to get the slope and this particular constant value. We look at the regression down. Simple equation is, if you could remember, it's y equals mx plus c. Can you remember? Equals c plus mx. That's the simple
Mhm.
equation that we have done in grade 7, isn't it?
Yeah.
It's never, right? So that is a simple equation, right? So
Yeah.
the equation is also like that, but you are getting a particular values for that.
Ah, okay.
Right? You are getting a particular values. Now, let's say, for an example, if you could write it down, let's say y equals, right? If you don't mind, could you please write this down? Y equals,
Sure, sir.
yeah, y equals
Mhm.
0.1,
Mhm.
right? Plus 2.3,
Mhm.
2.3. Next hand, you could write it like beta 1, 2.3 beta 1, right? Plus
Mhm.
3.2 beta 2. Beta means n, right? In your y equals c plus mx. Beta means that particular n, right? Slope. Okay, so that is the equation y equals 0.1 plus the other one is what? 2.1 beta plus 2.3 beta 2. Correct?
0.1 plus the
0.1 plus 2.1 beta 1 plus 2.3 beta 2.
2.1
Okay,
beta
that's
1.
the equation. Actually, this type of equation you will be getting. Now, this
Okay.
0.1 means Kuta, that is the intercept, that is C. 0.1, the first variable after the equal marks. 0.1 is the constant or the C.
Okay.
Okay, and the 2.1 is the first independent variable in your equation. It means your foreign direct investment. Because you are going to identify the impact of foreign direct investment on that Y no? Stock market development. Y is the stock market development.
Okay.
Okay. But here I have I have again taken another variable 2.3 beta 2. That could be another variable, but it's not relevant to your one. Okay. So
Okay.
this is
Okay.
simply the equation that you are getting.
Okay.
Right. If you type slope by considering all these values, you are getting that 2.1 figure because that's the slope. Right. And if you type equal constant and track the entire series, you are getting that C value. Okay.
Okay. Okay.
So you need to combine it and write it. Is
Hmm.
that clear up to now?
Yes.
Okay.
First.
Right.
Okay.
Okay. So then how you interpret it?
Mhm.
There are some other p values that you need to measure the significance as well. In there, I have already mentioned it there. But simply here it says, if the foreign direct investment increases by $1,
Mhm.
there is an impact of 2.1 to the stock market development. That's the meaning of that 2.1. It's mean the sensitivity. Right? So if there is an increment of the foreign direct investment by dollars, $1, there's an impact to the stock market development of nearly 2.1. 2.1. So that's the meaning of that. And thereafter I have mentioned you need to interpret the results as well, and whatever and summary. Those are very easy things because now we just say there's an impact of 2.1. We need to prove it statistically. Am I correct?
Yeah. Yeah.
Right? So that proof will be given by that p-value table in your model summary and information table. That's what you have to type in the YouTube and find out interpret.
Okay. Okay.
Is that okay?
Yeah. Yeah. Sure. But in that
Okay,
case, sir, for
good.
the first part and the second part, those are independent parts. Like first part, in the sense we have to give the some like comment on the literature review, and second part we have to comment on based on our calculation.
Yes, yes, yes. You need to interpret. Just interpret it. Don't do
Okay.
that much. Just interpret it.
Okay. 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 Thank you very much, sir.
Fine, fine, fine. So we'll start within 2 minutes.
Okay. Thank you, sir.
Right, yes, students, we are going to. Yeah, we are going to start. Students, I believe that you are also there. Right. So we have done with the first approach with regard to the capital structure theory, right? Net income approach, right? So in there we believe that the cost of equity does not depend on the financial leverage of the company. Accordingly, it goes uh, horizontally, right? It goes horizontally. And the other parts are clear. Cost of debt is anyway constant. And we believe that cost of debt is lower compared to cost of equity. Accordingly, cost of capital declines. And at this point, the cost of capital will be minimum, which means we can assume that in here, then the debt portion of the company is 100%. Right, the portion of the company is 100%. So accordingly, at this point, value of the company is maximum. Right, value of the company is maximum. Okay, so that's all about this particular theory, net income approach. Right, net income approach. Now we are moving to another theory. Don't look at there, right? Don't look at there. We are moving to another theory that is the traditional approach that you have, right? The traditional approach that you have. Taken here. The traditional approach that you have, right? Sorry, right? So here, let's say when the debt capital is high, right? When the debt capital is high, the financial risk, right? Financial risk will also be high, right? Financial risk will also be high. Then equity shareholders, they're asking a higher required rate of return, right? Then what happened? The cost of equity of the company will also be high, right? Cost of equity will also be high. Now, when it's come to this traditional approach, right? When it's come to this traditional approach, here you have your financial leverage, and here you have your cost. Right now, Huda, when it's come to this traditional approach, this does not believe about constant cost of equity, right? This does not believe about constant cost of equity. So here in this particular approach, they assume that cost of equity changes with the financial leverage, right? Cost of equity changes with the financial leverage. Is that clear? Good. Now what happens? We know that anyway, the cost of debt remains same, right? Cost of debt remains same, and the cost of equity is higher than cost of debt, right? Cost of equity is higher than cost of debt. Those are the two things that we know up to now, right? Then what happens when you are increasing your debt capital, right? When you are increasing your debt capital in the company, right? Debt capital in the company. Here you have your cost of equity, right? You have your cost of equity. Again, it will also increase, right? When you are increasing, we are moving part by part. That is the best way to learn. When you are increasing the debt capital in your company, cost of equity starts to increase, right? Cost of equity starts to increase. Then what happened, right? Then what happened? If the cost of debt is cheaper than cost of equity, your WACC starts to decline. Okay, your WACC starts to decline. For the moment, okay, right? Then what happens when you're right when you're further increasing your debt component, right? When you're further increasing your debt component, your cost of equity increases, right? Your cost of equity increases. It's obvious, right? Because when they are having the more debt capital in the company, the financial risk will be high. Accordingly, they are asking a higher return and the cost of equity must be high, right? So cost of equity will be high. But still, what happens? Your weighted average cost of capital declines. Still, your weighted average cost of capital declines, right? Due to lower cost of debt, right? But there is a point where this reaches its minimum level, right? Your cost of capital reaches minimum level. Why? Even though your cost of debt is, right now this is your cost of debt, even though your cost of debt is lower and lower, after some time, that higher amount of debt cannot be borne by the equity shareholders of the company. Clear? That higher amount of debt cannot be borne by the equity shareholders. Why? They know that at the time of liquidation, they have not been guaranteed that they are getting the priority. Then what happened? Even though the situation is like that, you keep on increasing the debt portion of the company. Right? So if they are entitled to receive at least a single coin, now they can't because the debt portion of the company is high. What they do after this point, they are right after this point, they ask more returns from the company. Right after this point, they ask more returns from the company. Right. Accordingly, this cost of cheaper debt will be offset by the higher increment of cost of equity, right? The lower cost of debt will be settled off with uh, this higher cost of equity. Then what happens? Cost of capital of the company starts to increase. Okay, this is your cost of capital. Cost of capital starts to increase. Okay, is that clear? Right. So this is little bit practical, right? Practical, right? So this is we call this as this is your first stage, right? This is your first stage, right? First stage, yeah. First stage. During this first stage, what happens? You are issuing your debt capital, and cost of equity increases little by little with the levels of financial leverage. But your cost of capital starts to decline. Why? The reduction of cost of debt is higher than the increment of cost of equity. The net result gives you the lower WACC to the company. But there is a point where it can be borne by the equity shareholders of the company. Even though the cost of debt is lower, since the cost of debt is lower, you are increasing the amount of debt capital in the company. So accordingly, it cannot be borne by the equity shareholders of the company. Clear? It cannot be borne by the equity shareholders of the company. Then what happens? Equity shareholders of the company are trying to ask more return from the company. Right? Equity shareholders are trying to ask the more return from the company. Accordingly, cost of equity will be high. Right? Cost of equity will be high. So this is the first stage, and we could say this is the third stage, and this is the second stage. Right? This is the second stage. Okay, first stage, second stage, and the third stage. Right? So then what happens? Now don't write up, don't write anything. Just look at this board. Just look at this board. Now, if you look at this particular illustration, at which point the optimum capital structure occurs? Huh? This point, right? So at this point, the optimum capital structure occurs. Why? In here, your cost of capital is minimum, right? So optimum capital structure means, again, I'm writing here, right? Optimum capital structure means your cost of capital is lower and the value of the company is high, right? Value of the company is high. Clear? So at this point, what happens? Value of the company will be high, right? Value of the company will be high. So if we draw it like this. So this is your debt to equity mix, and this is your cost, right? So the initial stage, what happens? Your WACC declines. WACC declines means your value must be increase or decrease. WACC declines, value must be increased. So this is the increasing part, first stage, right? First stage, your WACC declines, your company value starts to increase and it goes like this. Clear? Then your WACC is minimum. At that time, you are reaching the maximum value of your company, right? You are reaching the maximum value of the company, and that is your second stage, right? That is your second stage. Clear? Then what happens? WACC starts to increase. What will happen to the value? Starts to decline like this. This is the third stage. Third stage, right? So this is simply the traditional approach to capital structure. Traditional approach to capital structure. Easy, right? Online students, are you clear with this? Online students, are you okay with this?
Yes, sir.
Yes, sir.
Okay, so India, you have the value bar, not the cost here, right? It's my mistake, and thank you very much for the correction. Right, so here you have the value. Here you have the value. You could read, and if you have any doubt, you can ask. Okay, clear. So now you have learned two types of theories, right? You have learned two types of theories. What is the first one? X. What is the first one? Net income approach, right? Then the second one, traditional approach. Okay, good. So both of these says the company's capital structure is having an impact to the value of the firm. Right? So that is our objective. So our objective is to identify which type of an impact that these capital structure theories are having on company value. Right? In the first one, yes, it may have an impact. The second one, in the traditional approach also, yes, you have an impact. So now we are going to look at the relevance of the capital structure theories, right? Relevance of the capital structure theories, and here you have a particular right theories to learn that is coming under the Modigliani and Miller, right? Modigliani and Miller, some of the pioneers in finance who developed certain theories. Sometimes you might have heard these names as well, right? Modigliani and Miller. Now, right. So actually, he developed few models, right? Modigliani-Miller proposition 1 without tax, Modigliani-Miller proposition 2 without tax, and the other one is Modigliani-Miller with tax, right? With tax. So this is our first two, Modigliani-Miller proposition 1, proposition 2, right? Proposition 1 and proposition 2. So it's very simple, right? It's very simple. Right? So it's very simple, right? Now, in here, this particular person tells, right? Modigliani Miller proposition 1, he tells that, right? It's all about assumptions, huh? It's all about assumptions. He tells the capital structure of the company does not have any impact to the value of the firm. The capital structure of the company does not have any impact to the value of the firm. Capital structure, no impact to the value of the firm. Okay, capital structure does not have any impact to the value of the firm. Under proposition 1, this is what he tells. Okay, so he tells the capital structure only affecting, right? The capital structure only affecting how or when the earnings are distributed. Right? When the earnings are distributed. Right? It only impacts to how the earnings of the companies are going to be distributed, and the capital structure of the company does not have any impact to the value of the firm. Why? Capital structure does not determine the earnings potential of the company, right? The earning potential of the company. It does not determine the earnings potential. It's based on the assets, right? Return on assets, right? It's based on the assets. And also, it does not have any impact to what? The business risk, right? Business risk. Okay. So accordingly, the company, if the company if the company is having the same net operating income and the same business risk, right? Same net operating income and same business risk, but differ in capital structure, the value of the both firms are same. This is what is it, right? If the company is in a same risk class, and if the net operating income of the company is same, but their capital structure is different, the value of the both companies are same. Right? Value of the both companies are same. Why? The capital structure does not tell you your earnings potential as well as the business risk. Accordingly, if your capital structure is different, the market value of the company of the market value of the both of these companies are equal. Right? So he's having these type of assumptions for his to build up this particular theory. He assumed that perfect capital market is there where you don't have any transaction cost, no taxes, right? And homogeneous risk classes. Risk is same, right? Risk is same. And even the business risk is also same. You don't have any taxes and the company pays their entire earnings as dividends, right? The company pays their entire earnings as dividends. Okay. So he tells that the capital structure of the company does not have any impact to the value of the firm, right? Value of the firm. That's it. Okay, so here, if you look at this particular point, you could say this molecular proposition one is that for the firms in the same risk class, right? Look at that. Same risk class, the total market value is independent of the debt to equity mix, right? The total market value of the company is independent, which means it does not depend on debt to or the capital structure. Right? So simply how you got it, operating income divided by the cost of capital of the company, right? Appropriate to risk class. So here you could see value of the levered firm. Levered firm means what? Value of the levered means what? If you have both equity and debt, it's a geared firm or levered firm. Unlevered means you have only equity, right? You have only equity, right? So if you are a levered company, the entire earnings are divided into two parts. The entire earnings are divided into two. One component for debt holders and the other component for equity holders. Good. Dividends and interest. And if you look at the unlevered firm, the entire earnings are attributable to whom? Equity holders. Right? Equity holders. So, right? So you have your net operating income together. Right? Then you divide it by your cost of capital. Here they assume that value is same. Value is same. Value is same because they believe that this cost of capital does not have an impact to the business because of that particular assumption. Right? Right? Here you could see this is the way how it behaves. Right? Cost of equity of the levered firm is also equal to the cost of capital of cost of equity of the unlevered firm is equal to the cost of capital of the levered firm. According to this particular model. Value remains same. Value remains same. Okay, I'll explain it again. So here it says the capital structure of the company does not have any impact to the value of the firm. Right? Capital structure of the company does not have any impact to the value of the firm. The capital structure is impacting on how we are going to distribute the earnings. That's what they believe. Right? And the earnings and the business risk does not depends on capital structure. Right? Earnings and the business risk does not depends on the capital structure. Clear? Right. Okay. Then they say if a company is having same net operating income and same business risk, but different in capital structure. One company may have equity, the other company may have both equity and liability. Then the value of the both companies are same because of these assumptions. Right? These assumptions. Understood? We can do value of the unlevered firm and we can do the calculation, but it's not there in your level. Just explaining the model, we can even discuss the how these values are equal. Value of the levered firm is there, value of the unlevered firm is there. We could discount and we can prove. If we can prove it. Based on assumptions. Because for an example, let's say, right? Let's say, okay, for an example, let's say you are a company, you are a levered firm, right? You are a levered firm. Levered means what? You have both equity and debt. Equity and debt. Clear? Your entire earnings of the company is, let's say, 1,000, right? The entire earning of your company is 1,000. Okay. So let's assume that you are going to provide 600 as dividends for your equity holders. Clear? Then the remaining 400 for your debt holders. Remaining 400 for your debt holders. Yeah, right. So is that okay if I list this? Is that okay if I list this? Right? Right. So what happens here? Yeah, 600 for equity shareholders and 200 for debt holders. Right? Debt holders. Is this clear? Clear? So here you can simply calculate the value of the equity. How? 600 you can divide by your cost of capital. Right? Net operating income attributable to equity shareholders. You are going to discount it from the cost of equity. Right? Cost of equity. Let's assume that cost of equity is 6%. Right? This is your cost of equity. Yeah? don't do this calculation, would definitely wrong, because we are taking the assumptions, I mean, the numerical figures, right? So let's assume that your value of equity is 200, right? Value of equity is 200. Assumptions, we haven't done any calculations, 200. Clear? Good. Then you can calculate the value of the debt as well. So simply you are going to provide 400 as interest. Let's assume that cost of debt is 4%. Cost of debt is 4%. So finally, value of the debt, let's say, let's assume it's 3,000. For the moment, would be wrong, could be higher, could be low, whatever. Clear? Okay. So what is the value of the firm? 2,000 plus 3,000. Value of the entire firm equals to 5,000. Clear? Value of the, you can do this another way, but to make it simple, I separately discounted the income attributable to those two. Otherwise, you can directly take it. Right? How? 1,000 divided by the entire cost of capital of the company. That simply you can get the value, right? So this is the value of the levered firm, right? Value of the levered firm. Then on the other hand, we have unlevered firm, which means you have only equity, right? You have only equity. Same net operating income and same risk. So here your net operating income is again, let's assume it's 1,000. It's 1,000. Okay. Now this entire net income attributable to whom? Equity shareholders, right? Equity shareholders, and the cost of capital remains same, right? So value of the firm, right, equals to 1,000. You are going to divide it by the overall cost of capital, and now it is equal to, let's say, 6 plus 4%. Let's say it's 10, right? Let's say it's 10%. This is the entire cost of capital of the company, and this value must be equal to this value. Clear? That is what we say, value of the levered firm is equals to the value of the unlevered firm. Because in here you are segregating, very simple, right? In here you are segregating your income is net operating income is same, right? So here you are simply segregating your entire net operating income to the equity shareholders and debt holders. Then you separately discount it and get the value. But here you do it at once. Why? The entire net operating income is attributable to your equity shareholders. So here the cost of capital is equals to cost of equity here, because you only have equity capital. That's the assumption. The value is same. These values are wrong. This is for you to get the understanding that the value of the levered and unlevered firms are equal. Now is it okay? Because we assume that the two companies are equal, same market take by equal market share, it is same based on that. Okay, are this clear? Okay, online students, is it clear for you all? Online students, is it clear for you all? So please note that these values could be wrong. Huh? Once you divide 400 from 4%, could be a different answer. Definitely it's wrong, but it's just to for your identification purpose. Okay. So what is the most easiest lesson in your finance syllabus? What is the most easiest lesson? Huh? Yes, what is the most easiest lesson? Yes, Puka, what is the most easiest lesson? Revision. It's easy, no? Started your assignment. Did you start your assignment? I have uploaded the group assignment as well. But actually, I'm sorry, it delays for 1 week. After us, I think he sent me last week. I couldn't upload it. I'm sorry for it. Huh? But now it has been uploaded. You can start working on it. Right? So is this clear? Okay, is this clear? Right. So what are the three theories that you have learned up to now? Yes? Listen, huh? What are the three theories that you have learned up to now? The first one is net income approach. Sometimes we call this as net operating income approach. Right? Modified Miller proposition 1. Sometimes we call this as net operating income approach. Why? We are discounting the net operating income. Right? That is why we say it like that, net operating income approach. Right? The first one is net income approach. In there, you believe just think whether you are okay with these things. First part is net income approach. In there, we believe that cost of equity does not depends on financial leverage. Accordingly, cost of equity remains same, and also you know that cost of debt is always remain same, right? So since the cost of debt is comparably low to the cost of equity, cost of capital declines, right? So the minimum point occurred when you issue 100% of debt capital. Right? So that will be minimum at that point, and the company value will be maximum. Okay. And the second one is traditional approach. In there, we do not believe that the cost of equity remains same. It depends on the financial leverage. Cost of debt, yes, it's fixed. Then the cost of equity starts to increase little by little when you introduce more debt to your company, right? But in the first stage, we have 3 stages. In the first stage, your cost of capital declines, right? Your cost of capital declines. But there is a point where the higher amount of introduction of debt cannot be borne by the equity shareholders of the company. After that point, what happens? They are asking more return from the company. Then what happens? Cost of equity will increase rapidly more than the cost of debt. Then that turns other way around, right? Declines, reach a minimum point, starts to increase. Then the value of the company also starts to increase, reach a maximum point, then starts to decline. Okay. Third, Modiglian-Miller hypothesis. Without tax, we have two parts, proposition 1 and proposition 2. In proposition 1, we believe that the capital structure of the company does not have any impact to the value of the firm, right? So why? The earnings and the business risk does not depends on capital structure. So we assume that, not we, they assume that if the two companies are having same net operating income and same risk class, but the capital structure is different, which means one company must definitely be a lever and the other one must be unlevered. The value of the market value of both companies are same. Okay, value is same. So this is how you prove, and again, I'm saying the answers could be wrong. Because why? You are looking at these things day before the examination. Then you might doing the calculation for 3 hours, how this comes, right? 400 divided by 4% is 3,000. You're asking, how it happens? How it can't, right? Again, please understand their answer would be wrong. Okay, right. So then we are moving to the other part, that is Modigliani with the proposition 2, right? Modigliani with the proposition 2. Is that okay if I erase this? Online students, is that okay if I erase this? Online students, is that okay if I erase this?
Yes, sir.
Right. Okay. So Modigliani with the proposition 2, right? Proposition 2. Now, they are in a different mode, right? Earlier they thought something, but since they are in a different mode, now they are thinking a different, right? But same two personalities, Modigliani and Miller. Now what they say, yes. Now this is your financial leverage axis, debt to equity, and this is your cost, right? This is your cost. So they say yes, cost of debt. Now you know these things, huh? Cost of debt remains same, right? Cost of debt remains same. Cost of equity increases, but they say WACC remain same. Now I told you they are in a different mode, huh? Different. At first they said something, but now they are saying another thing. After that you could say another thing. They remember tax incorporated. That is the other approach, right? So here they say yes, your cost of debt remains same, cost of equity increases, but the cost of capital of the company remains same, right? This is the ultimate outcome of their thoughts, right? So why they say it like that? So they say, now you know that debt is lower cost financial instrument. Clear? Debt is lower cost financial instrument, right? They say the reduction of weighted average cost of capital, right? They say the reduction of weighted average cost of capital due to low cost debt, right? Okay. The WACC will be reduced due to lower cost of debt, right? When you are increasing more and more debt capital to the company, that will be reduced due to lower cost of debt. On the other hand, when you are increasing debt components in your company, what will happen? WACC will be, yes, WACC will be high, right? WACC will be high due to what? Due to financial risk, right? Due to financial risk. Okay. So reduction of WACC due to lower cost debt is there, and the WACC will be increased due to higher financial risk. So WACC will be reducing. On the other hand, WACC will be increasing. So they say the net impact is nil. Accordingly, WACC remain constant. Accordingly, WACC remain constant. For an example, let's say you are introducing more debt capital, WACC will be reduced by 5%. But since you are increasing more debt capital, WACC will be increased by 5%. What is the net impact? Nothing. Right? Nothing. Accordingly, that relationship will hold all the level of financial leverage. Not only this, not only this, during this period. Clear? That particular relationship hold in all the financial leverage positions. Right? So they say yes. The WACC cannot be influenced by level of gearing. That is what they say. WACC cannot be influenced, right? Weighted average does not depends on capital structure. WACC cannot be influenced by level of gearing. Gearing means financial leverage. That cannot be influenced by level of gearing. Is it true here? That does not depends on the financial leverage, right? It could be, but the net is nothing, right? So that cannot be influenced by the level of gearing. Therefore, value of the company, right, is independent from level of gearing. This is what they say. Because your value depends on capital, cost of capital, right? Your value depends on cost of capital. So here, your cost of capital does not change, then what will happen? The value of the company does not change with the level of gearing. So here you have the cost of capital. Here you have the value of the company. Here you have the value. Right? Whatever the debt to equity amount that you have, the value of the company remains same. Because here that is not influenced by level of gearing. Accordingly, value of the company is also independent from level of gearing. Right? Value of the company is also independent from level of gearing. Okay. Right, yes, so online students, are you all okay with this? Are you all okay with this? Online students?
Yes.
Online students, are you all there?
Yes, sir.
Right. Okay, so is this clear? Right, so again, I'm saying, when you are introducing more debt capital to the company, since the cost of debt is cheaper, WACC reduces. Agreed? Okay. Simultaneously, when you are introducing more debt to the company, due to the financial risk, WACC increases. Clear? Let's say if it happens in the same proportion, the net impact is clear. That's what these people says. Right? So that cannot be, that does not depends on level of gearing. Right? That does not depends on level of gearing. Since the WACC does not depends on level of gearing, value of the company is also does not depends on level of gearing or independent from level of gearing. Okay. So in this type of a scenario, definitely the companies, if you look at the yellow color line there, right, yellow color line there. So definitely if this is the scenario, right, if this is the scenario, the cost of equity is higher than the company bank, right? Because if you know that when we were discussing the questions also, that is average one, right? There could be higher amounts as well as the low amount, that is the average one. Definitely cost of equity is higher than the bank. Cost of equity higher than the WACC. Why? You're asking a premium for the risk that you are going to bear. That's what here it says. The cost of equity for a levered firm should be higher than the opportunity cost of capital. If you are a levered firm, means you are having both equity and debt, right? So you're asking a more return from the company. So that is higher than that company's overall cost of capital. Right. That is the relevant, yeah, that is the levered firm's cost of equity is higher than the same company's cost of capital, because cost of capital is average value, right? So it should be equal to the constant cost of capital plus the financial risk premium that you're going to ask. Like you're asking a premium. I'm investing in this company, but I have that much of an opportunity. I'm coming to a company with a risk. So please compensate me for that risk. Okay. Right. Okay. So now we are moving to the final theory coming under the capital structure theories. That is very simple one again. It's corporate tax. Right. So simply now another approach given by Modiglia and Miller. That is now we are incorporating the corporate tax part. Right. We are incorporating the corporate tax part to here. Right. Okay. Is that okay if I erase this? Clear? Fine. Right. Okay. Fine. Right. So what is the hypothesis with tax, right? With tax. Now, again, what happens? Right. So you have your debt to equity mix. Then this side you have your cost. Right. This side you have your cost. So then you have your cost of debt. It remains same. Right. Cost of debt. It remains same. Now, in here, we say that, I think you know this. Debt is, debt provides tax savings, isn't it? Debt provides tax savings because the debt, I mean, the company is giving some sort of a savings on interest on bonds or debentures. We call it as tax shield, right? We call it as tax shield. That is why, if you could remember when we were discussing about cost of capital, we had something called cost of bond before tax, cost of bond after tax, right? So these particular financial instruments, they save taxes. Now again, what happens? The cost of debt will be further lower, right? Cost of debt is further lower by now they are getting the tax savings as well, right? Tax savings. So here what happens, right? What happens again could be the same thing, but the concept is different, right? WACC of a company could be lower due to low cost debt, and now they have what? Tax savings, right? They have tax savings. It's operational matter. Huh? They are getting they are getting the tax savings. The companies are getting tax savings. It's an operational matter, right? So that reduce due to lower cost of debt, and they are getting the tax savings, right? But what happens here? Even though you are getting the tax savings, since the company is introducing more debt capital to the company, cost of equity, right? Cost of equity, it increases, right? This video, that video, it will increase, right? Cost of equity. This is the thing that you know up to now, right? When you are introducing more debt, cost of equity increases. And when you are introducing more debt, weighted average cost of capital will be lower. Why? The debt is lower cost compared to equity, and now they are getting the tax savings as well. Further reduce the cost, right? And on the other hand, when you are introducing more debt to the company, weighted average cost of capital of the company will be high due to the financial risk, which is borne by the equity shareholders, right? Financial risk borne by the equity shareholders. Clear? So now here they believe that the reduction of weighted average cost of capital is higher than the increment of weighted average cost of capital. The reduction of weighted average cost of capital is higher than the increase of weighted average cost of capital due to financial risk. Accordingly, WACC reduces. Clear? WACC reduces. This is what they believe. WACC increases, WACC decreases. In the earlier stage, we believe that it is net off. But now we are incorporating the tax as well, and now we say debt will save more cost. Accordingly, the reduction of WACC is higher than the increment of WACC due to financial risk. Accordingly, what will happen? The cost of capital of the company decreases, then this is the value of the company. The value of the company increases, right? Value of the company increases. So here it starts to decline, it starts to increase. Here it's further decline, then decreases the, yeah. We can't say maximum because you could go further. Right, so before you write this down, just look at this slide, right? Just look at this slide. So here it says, molecular meter show that the value of the firm will increase with debt due to the deductibility of the interest charges for tax computation, right? That will increase with the debt due to the deductibility of the interest charges for tax computation. And the value of the levered firm will be higher than the value of the unlevered firms, right? Value of the levered firm is higher than the value of the unlevered firm. Is that clear? So this is a levered firm or unlevered firm? It's a levered firm. Now you could see value is high. Why? You are getting the tax savings and also debt is lower cost. Accordingly, our WACC is decreasing and the value increasing. Now, if you look at this particular illustration here, right? If you look at this particular illustration here, you could see that there are two companies, firm unlevered and firm levered, right? Firm unlevered and firm levered. Now, the net operating income of the both companies are same, it remains 2,500. And you don't have any interest component for this particular company. Why? It's only unlevered, right? You did not issue debt time. Accordingly, you don't have interest, but this company is having the interest amount. It's 500, right? So here it says the amount of debt is 5,000 and the rate is 10%. So accordingly, it's 500. Accordingly, 500. Then if you look at the taxable income, here it's 2,500 and there it's 2,000. Taxable income. It's 2,500 and there it's 2,000. So this is the saving that you are going to get, right? Then you are going to do the taxation, it's 50%. So here it's 1,250 and here it's 1,000. Now this is the income after tax, right? Income after tax. So here it's 1,250 and there it's 1,000. Okay. Now is it clear? Now if you look at the total income that has been generated by the company to their investors, totally the unlevered firm will only provide how much? 1,250 for their equity shareholders, income after tax. But the levered firm, they provide 1,500 to their investors. Right? Simply they are providing dividends plus interest. So such company shareholders or the investors are more satisfied than the investors of this unlevered firm. Right? So it may have an impact to the market price of the company reaching the higher value. Okay? Reaching the higher value. So here you could see the interest tax shield is also there. Right? It's they are giving the tax savings of yes, it's 50% tax savings. Out of the interest, it's 500 and the tax savings is also 250. Right? Tax savings also 200. So you are getting that saving accordingly, WACC increases. Right? WACC increases. Okay. Yeah. So could you please rate this up to this point? Did you all find? Right, so please now when the things are, if you have more, paras and all, it's get little bit confused. That's why I'm using this particular approach, and I believe that you can get an understanding. Right, because if the same thing appear in a para it's a lecture note. Right? It's a lecture note, but this is the delivery. Right? That is the lecture note, and this is the delivery. The delivery would happen in this way. But if the same thing have been written in that type of way, it will be difficult for you to understand the thing graphically. That is why I'm using this approach, because once you look at this, WACC is reducing, WACC is increasing, but this reduction is higher. You can directly identify it. Right? So finally, this is what you could see here. Here you have the value of the unlevered firm is there, right? And this is the value of the levered firm, right? Levered firm value is higher, right? Levered firm value is higher. Anyway, it could be increment value of the unlevered firm could be either be increment or whatever. Anyway, what you want to know is value of the levered firm is high, right? The difference is tax savings and the cost savings. Right, so here it says that in accordance with this particular approach, right? In accordance with this particular approach, it suggests that because of the tax deductibility or the tax savings of interest charges, a firm can increase its value with the leverage. That's what you could see here, right? Why? WACC decreases. Accordingly, value of the company increases. Therefore, the optimum capital structure is reached when the firm employs almost 100% debt, right? According to this particular model, right? According to this particular model, if you introduce your entire capital structure, right, as debt components, as debt capital, you can get the maximum benefits. But there are issues. Can you do it practically? You cannot, right? Why? Bankruptcy risk is there, isn't it? Bankruptcy risk is there. You are issuing more and more debt, but you need to guarantee that you have to pay it. Right? So bankruptcy risk is there. Practically you can't, right? Theoretically you could, practically you can't. But still, we are using this particular knowledge when developing or when making decisions in the practical sector as well. This knowledge, we know that if you increase more debt, we know cost of equity is high, right? So that's not change, not change, right? So these are some of the directions. All these theories are some of the directions as a finance manager for you to take it when you are going to make that decision. I'm not going to go and show this is what happens when big lines. I'm not going to show, but you use this knowledge to make decisions. So then it says in practice, look at that. In practice, firms do not employ large amount of debt. No, are lenders ready to lend beyond a certain limits which they decide? Right? Usually companies are not issuing more debt, and even the companies wishes to issue more debt, people are not providing because they know that the entire company is funded from debt. If something happens, they might lose. The bankruptcy risk is there. Right? Bankruptcy risk is there. Okay. Fine. So what are the theories that you have learned? So you learned net income approach, traditional approach. Then money plan Miller proposition 1, proposition 2. Money plan Miller with corporate tax. We have another model called Miller, right? So finally we are going to look at something called it's a little bit right. So it's like this, right? It's like this. Now let's say you are going to buy a vehicle, right? You are going to buy a vehicle. What is the first thing that you are going to look at? I think I discussed this in the first day under capital structure, if I'm not mistaken, right? You are going to buy a car. What is the first thing? Let's say it's 4 million. Why you are going? What is the first thing that you are going to look at? You are going to look at savings. Good. First, you are going to look at savings. Then you may ask from your parents sometimes. Okay. So if not, right? So if that is also not limited, then you go for a bank. So sometimes you may ask some amount from bank or remaining amount from your parents. Okay. So when it comes to some practical aspect, first the company look at now. Why we discussing about this capital structure? Because we have investments. right? We have investments. So we have to finance these investments. Am I correct? That's what we're looking at, how to finance, whether to go with more equity or debt. Right? So usually what happens when you're having most these type of investment decisions, most of the time, not all the time, most of the times, the company look at whether they have what? Retained earnings at first, like you, savings, whether the company is having retained earnings or savings. If the retained earnings are not sufficient, since the cost of debt is lower, they are going for debt, right? They are going for debt. Then again, if it is not also sufficient, they go for equity. Okay, so it's like order. First you look at your reserves, then you look at your debt capital, then you look at your equity. So it's a order. We call it as pecking, right? Pecking order theory, right? Pecking order theory, right? So that is what the final part, right? Pecking order theory. Right, so the pecking order theory is based on the assertion that the managers have more information, right? Managers have more information about their firms than investors, right? So managers know what is there internally. And this disparity of information, we call it as information asymmetry, right? You know, managers know better information than investors. So information asymmetry is there, conflict of interest, then agency problem. Can you remember it? We discussed, right? Okay, so the manner in which the managers raise capital gives signals about their belief in the firm prospectors to investors. Now, if you are a shareholder or the major shareholder of a particular company, you look at how the company is getting finance. Based on that, you can get an idea whether the company is having sufficient cash flows or not. So this also implies that firms always use internal finance when available. Most of the times, choose debt over new equity or external financing if required. So it's like order. It could be this or that whenever it's order. So we call it as pecking order theory, right? We call it as pecking order theory. Right? Difficult. Plenty to learn, isn't it? Right? Okay, so that's the end of your lesson, capital structure. Right? That's the end of your lesson, capital structure. Right? Right, okay, yes. Now we have completed your capital structure lesson and we can wind up. Today's lesson, again, it's an assumption, right? Right, okay, fine. So, yeah, okay, we can wind up. Summary. Can someone give me a summary about today's lesson? Yes, can someone give me a summary about today's lesson? Can someone give me a summary about today's lesson? Can't? Shall I pick? Right, okay. So now what we discussed today, right? So please provide your fully concern, now. Please provide your fully concern. Maximum 10 minutes, right? Maximum 10 minutes, maximum 10 minutes. Okay. Now, if you look at this particular diagram, you can understand why we have done this particular lesson, capital structure. Because again, I'm saying at the very beginning, you're making your investment decisions, right? You're making your investment decisions. Then when you're going to make your investment decisions, you need to simultaneously look at whether you have available finance for that, your financing decision, that is your capital structure decision. So when you are going to decide this much of an equity and this much of an debt capital that you are going to have, you need to first think about your existing capital structure. Your existing, how much of debt and how much of an equity capital that you have for the moment. Simultaneously, you have to think about the how much of dividend that you have paid and have to pay because of this change. Right? So these two will help you to determine some sort of an idea about your capital structure. Then when you are going to make that decision, definitely it may have a risk as well as a return. You know it. Then these risk and return impact on company's cost of capital. Right? This risk and return impacts on company's cost of capital. So this cost of capital impact on calculating the value of the firm, because net operating income divided by cost of capital, that is how you calculate the value here, right? So capital structure is having an impact to the value of the firm according to this discussion. Then as a manager, we have to determine what is the optimum capital structure to the company, which brings the weighted average cost of capital to a minimum point, as well as which maximize the market value of the company. Right? So this is the roadmap. This is the justification for the today's lecture. Right. So first we learned about what is capital structure. So it's simply how the company is being funded for their long-term investment. We didn't bother about the working capital management because it's short-term. Right. So how you fund for your long-term investments could be equity, could be debt, could be both. That is simply what capital structure is. Okay. So thereafter, we started learning about two types of leverages, financial leverage and operating leverage. Financial leverage means the amount or the percentage of your debt component to your equity or to your total capital structure. Clear? Then we discuss something called degree of financial leverage, right? Degree of financial leverage. It simply measures the sensitivity of your earnings per share to the earnings before interest and tax. Then we got to know how to interpret the results as well. Then we analyze the impact of leverage on profitability. If your cost of borrowings are lower than the return, it may provide a positive signal to your profitability. If it is not, it's unfavorable and it provides a negative signal. Then we started discussing about operating leverage. It's simply the amount of fixed cost in your company to the total cost. Depending on that, you may have a high operating leverage or a low operating leverage, right? So then we discuss about the degree of operating leverage. So simply it says the sensitivity of the company's earnings before interest and tax to its sales. Then again, you got to know how to interpret the results. So after that, we combine both financial and operating leverage. Then we come across something called combined leverage. It's simply change of the earnings per share divided by change of the sales. Okay, fine. So then we started discussing about capital structure theories. In there you learn net income approach, traditional approach, then Modigliani and Miller proposition 1, Modigliani and Miller proposition 2, then Modigliani and Miller with corporate tax, then finally making order here. Right, so these are the theories that we have learned. When it comes to the net income approach, so here we simply believe that the cost of equity does not depends on financial leverage. It remains same. Cost of debt also remains same. Since the cost of debt is lower, that reduces. Then if you introduce 100% debt to your capital structure, that will be minimum and the value of the company will be high. Summary. Then the second one, traditional approach. In here, we believe that cost of equity does not remain same. It changes with the financial leverage. Cost of debt, yes, it remains same all the time. So when you are introducing more and more debt to the company, what will happen? That will reduce in the initial stage due to lower cost of debt. But after a certain point, that starts to increase. Why? That higher amount of debt cannot be borne by the equity shareholders of the company. Accordingly, they are asking a higher return, cost of equity will be higher than the cost of debt, then the WACC will be higher. Right? So decreasing part, minimum point, higher point. Likewise, your value of the companies have increasing part, maximum point, and decreasing point. Okay. Then the Modigliani Miller part, proposition 1. In here, we believe that if the two companies, net operating income and the business risk is same, right? Net operating income and the business risk is same, irrespective of the capital structure, the market value of the both companies are same. We have proven it. Okay. Then the Modigliani Miller proposition 2. In here, what happens? Still, you have this particular cost of debt remains same. When you are introducing more debt capital to the company, what will happen? Weighted average cost of capital will be lower. Simultaneously, weighted average cost of capital will be high due to financial risk. But this is netted off. Accordingly, cost of capital of the company does not depend on financial leverage or capital structure. Accordingly, value of the company also does not depend on capital structure. Clear? Then, Modigliani Miller with corporate taxes. In here, we know that yes, cost of debt is less, and here you have the tax savings. Then what happens? WACC starts to decline, reach a minimum. WACC starts to decline and it remains declining trend. Right? Cost of debt remains same, and the cost of equity it increases. Right? Cost of equity it increases. So then what happens? The value of the firm will also be higher, right? If the company is entirely financed via debt capital, the value of that company is higher than the value of the equity finance company. But practically, you cannot do it because of certain reasons. So finally, we discuss about pecking order theory, which means it's simply about the preference. You go for a retained earnings first, then debt, and finally equity capital. So that is the end of today's lesson as well as the today's session. If you have any doubt, you can ask. Yes, online students, any issues, Sudhana? Any issues? Any unclear areas? Any unclear areas? Online students, are you there? Daya?
Yes, sir.
Janaka? Okay, right.
Oh,
Is
it's
it clear?
Yes, sir. It's okay.
Right. Okay. So are you all okay? Fine. Right. So please start doing your assignments because it will be due on 9th July. Thank you very much. And yes, online students, thank you very much. See you on next week, right? Okay, bye.